Insurance companies don't profit from selling policies, they profit from what happens after you stop paying attention. The standard story is simple. You pay premiums, the insurer holds that cash, invests it, and keeps the spread. And here's the trick, that's only half the picture. The real profit machine sits hidden inside something called the loss ratio, and it's where every insurance executive watches the numbers obsessively. Because if claims exceed premiums plus investment returns, the whole model collapses. Actuaries, these are the statisticians who run the engine. They build tables from centuries of death records, accident data, and disaster history. They calculate the probability that a 35-year-old male in suburban Ohio will file a claim in the next year. Then they price the premium just high enough that across thousands of customers the math works. It's not guesswork, it's applied mortality. But here's where it gets darker. Premiums aren't just set to cover expected claims. They're set with a built-in cushion called the underwriting profit margin, usually between 5 and 15% depending on the line of business. That means the insurer is banking on paying out less than it collects before a single dollar of investment income touches the ledger. Now add the second income stream, investment returns. Insurers hold billions in premiums they haven't paid out yet. That's called the float. They invested in bonds, stocks, real estate. In good years, those returns can match or exceed the underwriting profit. In bad years, when catastrophic claims spike, the float is what keeps the company solvent. So the real explanation isn't mystical. Insurers profit by collecting more in premiums than they pay in claims and by investing the difference at scale. They manage risk by using actuarial science to price accurately, and they transfer catastrophic risk to reinsurance companies, insurers who insure insurers. It's nested risk management, layer by layer. The implication? Insurance isn't gambling, it's statistical certainty wrapped in contracts. The house always wins because the house calculated the odds first. And if premiums rise over time, it's not price gouging. It's actuaries recalibrating based on new claims data, inflation, and shifting risk profiles. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you want to understand how the world's largest industries actually function, not how they're advertised, but how they are engineered, subscribe. There's a new business model breakdown every week. Subscribe, there's a new business model breakdown every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.